Hey, good afternoon, everyone. Thank you for listening and watching the Blockchain Advisor channel today. I am so pleased to have once again on our platform Jay Pestrichelli. He is the man, the driving force behind the YieldMax ETFs, which you guys all love and are investing in for their yield, for the alternative asset class, and for your retirement. I mean, let's face it, the Facebook groups are blowing up with people who are using YieldMax to help fund their retirement. Jay, thank you for joining us today, and we have a lot to talk about.
Yeah, Bill, of course. Great to be back. Thanks for having me.
Oh, you're welcome. All right, so I'm just going to rip through these questions. We're going to do a slightly shorter episode today. We're going to try to keep it
Okay.
40 minutes. So, first question. Um, so for viewers who don't know that much about the yield banks, I'm going to encourage them to watch our first video because I think that was really a powerful one. So I
Yeah.
want this one to be a little bit more intermediate. Like I don't want to go too far down
Yeah,
the
like
down the
don't go
basics.
through the basics of YieldMax. Got it.
Right.
Okay.
They
But
can
I'm
watch
sure
that.
they're going to get touched on.
Oh, for sure. All right.
Okay.
So first question is, I personally was surprised to see the Berkshire Hathaway ETF in the option income side. And so because for me, Berkshire Hathaway's is as old and stodgy as Charlie Munger and Warren Buffett. Like what? Like weapons, options are weapons of like derivatives, mass destruction. And here, in a in a swing, in a fate of a paradox and contradiction, which I absolutely love, Berkshire Hathaway says it's now YieldMax ETFs. So the question is, what was so exciting about that particular listing? Like, what made you do that one and believe that BRK is actually a viable product that would attract assets under management?
Yeah. So, by the way, I hope it's not anything to do like Charlie Munger, considering his current state. Right. By the way, what a great investment guru. Like I've read, I've read his like 99 points of investings and all that. Like, you got to respect it, even though it might be, a different generation and a different way a lot of, individual do-it-yourselfers would view. But it's hard to argue with a lot of his points. Anyway, so what brought Burke to the table? Well, look, I think you know this, or maybe you don't. It was the seed that launched YieldMax, right? The YieldMax came from a discussion around, hey, Berkshire doesn't have a dividend. Could we do a covered call strategy where we could be long Berk and sell some calls out of the money and generate a little dividend? And now investors could be long Berkshire Hathaway but get a 5% dividend, right? That's how YieldMax started. And then we started iterating. It's like, well, yeah, it has
Oh,
weeklies. We could probably kick that up to 15%. Oh, what else has weeklies? How about Tesla? Oh, what's that implied volatility? 90. Oh, maybe there's some really interesting
yeah.
stuff here. So it was almost like I can't believe it's taken us this long, right? We filed for that first filing of all the initial yield maxes, right? Which Amazon, Nvidia, Tesla, ARK, right? That list had Burke in it. It is the last of the single stocks that we had not launched. And so, really, it's years in the making for us to launch that. Now, why launch it now? Well, it seemed like there was some momentum behind that idea, right? The last meeting that Berkshire had was a little polarizing, with Warren saying he's kind of leaving. I think there's just been a little momentum there, and we thought, you know what, we've had people asking for it. We do listen to our investors. We try to give them what they want when it's possible or feasible. So that was the reason why we launched it. And by the way, so when did it launch? It launched. I'm looking at my comparison. It looks like June 5th. It was the first trading day, and
Okay.
since that time, it's up about 83 bips. But Burke itself, Berk.B, is down 2.5%.
Wow.
So it's kind of doing its job, right? That cover call income is bringing a little outperformance in the slight, it's down. It doesn't always work where the, underlying's down and the yield max is up. But in this particular case, for this very short period of time, it's working. So, I think we're going to see. We're going to see what the adoption looks like. Normally, we don't really know what folks think about these funds until after the second distribution. The first sometimes can be very like jarring or misrepresentative. So after you
Mhm.
get two, people then decide if they're going to add it. Plus, we'll add it into the Y Max fund, our fund of funds, which is such a great way for beginners in Y Max to get exposure to So beginners in YieldMax to get exposure to a YieldMax portfolio, right? It's 37 single stock YieldMax funds. And so you get the diversification, but you still get the yield and all of the other beautiful things about YieldMax, or the distribution, I should say. But so when it finds its way into YMax, that is kind of an instant lift in volume and assets, and now all of a sudden, people won't feel like they're first to the party. So I think, 2 months from now, we're going to see what the adoption looks like.
Sure. No, I think that's great. I mean, I cut my teeth on the trading floor with the CBOE and I love MSTR. So I look at a 13 and a half implied volatility versus 140 of MicroStrategies, a few months ago.
I wish it was still 140.
I know, right? Me too. Me too. But it is what it is. It'll come back someday.
Yeah,
Uh,
so we'll see. Like, look, Disney's in there, JP Morgan's in there, right? Exxon's in there. Exxon's a little different because it has a high distribution of its own, which makes the option trading a little harder, right? The actual dividends on the underlying make it
mhm,
more difficult to do synthetics. Let's not go down that rabbit hole. I know you know all about that.
right.
But I would say, yeah, we have it. Like even Apple, right? 20 plus 20. Is it even a 20 vol right now? I'm not sure.
I can bring it up.
Yeah.
Okay, Apple. Um,
Microsoft, right? They're fairly low. Burke is more like an index, though, right? We
for
know this.
now, I mean, listen, we go through these periods, in my opinion, where this is the summertime blues. All right, so at the money, Apple 202. So at the money, July is 23.21 in terms of
Yeah, so
implied
we're selling
volatility.
much less than that because we're out of the money on that. So, like, it's not that far off of those.
It's
We
correct.
do have some index-based yield maxes. There are zero DTE products, right, where we're every day we're long the S&P or the Nasdaq or the Russell with a deep in the money call, and then we sell a call every single day. I mean, though, in that scenario, right, what's the VIX right now? 16, right? Is that what it
It's
is?
16 and a half ish. Sure.
16 spot four. So it's like, yeah, so we're still able to generate some yield on a lower volatility, but that's daily, right? So for those of you that are new to option selling, you make more selling one option 5 times a week than selling the 5 day option once, right? There's more time decay to earn. Like time decay is not linear, it's exponential. And so, which is why daily can make sense.
Mhm.
So I know I'm off on a tangent on the Burke, but you hit on the low IV. Yeah, it's going to be interesting to see how it goes. I think it may have a bigger appeal to the less risky folks like you that are willing to take the risk of a MicroStrategy or a coin or something like that. And they like, hey, look, I like the stability of Burke. And now I got a dividend. I mean, that really was the impetus of the whole thing.
I
Let's
love
see
it.
how it plays.
It's so funny because when I started at the CBOE, options were 3 month expiration cycles. Then we went to
It's a
monthlies. I'm
long
like,
time ago.
we went to monthlies. I'm like, that's the stupidest thing ever. Like you're just churning commissions. Now we're at zero date, and I love them now. Like I have a huge conversion. I'm doing dailies, weeklies. I mean, I absolutely love it. So yeah, my perspective has changed as I got older and wiser, hopefully. Second question. This is my personal question, right? This is not from the Facebook groups, but like tell the viewers and the listeners how the short option income, the ETFs like Fiat, DIPS, and Crash work, because I can't help but. I mean, I'm a huge blockchain guy, hence the name of the channel, The Blockchain Advisor. Coinbase is something I've followed for years. Now, it just, if you look at I like old fashioned point and figure charts. You look at that point and figure chart, straight up chimney. I mean, a huge spike, and it's turning around today. So I want to short Coinbase, but I don't necessarily want to buy an 80 vol or wherever the implied volatilities are. I want to buy, I want to buy fiat. The question is, tell me how differently these work than uh, the traditional option income ETFs.
Yeah, absolutely. So I'm glad you brought it up. Uh, yeah, and I'm going to even interpret a little bit about what you're saying is like, hey, you probably have a limited period of time that you want to be short Coinbase versus like long-term bullish, right?
Yep.
That is the use case for these. But let me tell you first how they work. Uh, but let's start by talking about how a cover call strategy. You're long the equity, you sell a call above it, right? You make money as the stock goes up, up, up to your strike. You also keep all of the income you made by selling that call, and then you're capped at that point, right? That's generally how covered calls work. For
Mhm.
us, we do cover call spreads. So we start to recap again if the market continues to go up. And your risk is all the downside. Not all the downside because you always keep the time premium from the call you sold. So in a cover call strategy, you're going to make generally 70 to 75% of the upside. It all depends on the ticker, but this is a generalization. And on the downside, you'll experience 90% of the loss. That's the profile of a cover call strategy. Now let's talk about the inverse, like crash, fiat, dips. These, by the way, those are my favorite names. Like crash, I think is the best name on Tesla.
I noticed that there was a woman whose last name was Pestrichelli on a Zega website, who I'm guessing is obviously related to you. She was in marketing. Is she the genius behind these four-letter symbols?
She's not actually. That is on
Oh,
the ETF side of the house.
okay.
Somebody else came up with those. Yes, that is.
Okay.
You're
I
talking
thought it
about my
was,
wife that works for Zega Investments, my former company. But let's not confuse anybody with that stuff.
gotcha.
That's a whole
Right.
nother. But anyway, everything's great there. Don't get me wrong. My
Yeah.
wife's wonderful, by the way. In case she's watching, I'm sure
Of
she
course,
will.
she's married to
Uh,
you.
yeah, she's a saint. Okay, so the inverse of these works the exact way a cover call strategy, but the other way. So we are short the stock, right? We want the stock to go down on an inverse exposure. We sell a put below, right? So stock's going down, you sell the put down. You have appreciation all the way down to that short strike, and you got paid for that short strike, and then you get capped on your gains regardless of how far it keeps going down. And then, we're long another put because we do spreads and then we're capturing more downside. But really, it's first you're capped on the way down. Conversely, you also have risk if the underlying stock goes up, just like how you have risk in Tesla when Tesla goes down, Tesla when Tesla goes down. So you have upside risk. Again, you'll probably lose capture 90% of the losses on appreciation of the underlying. You'll capture 70 to 75% of the gains on the way down. Now, there is one slight benefit that is a nuance, but it matters when interest rates are 4 or 5%. When you are long, and the way that YieldMax works is we don't actually own the stock. We synthetically create
Mhm.
the exposure by putting on a combo. I know that sounds a little complicated. All it means is we're long a call and short a put. That is the way we create the long exposure. When you do that, there is something known as a cost to carry, interest. You can't do that for free. The market will charge you whatever the 3 month treasury rate is for
Mhm.
that. Right now, it's in the high threes, right, low fours. So what happens is when you're long the combo, you pay the cost to carry. When you're short the combo, you earn the cost of carry, right? So in
Right.
that scenario, it's like you get to maybe double dip on the interest rate a little bit, right? So not only does it go to a cost to flat, but you earn it, so it's a credit. However, we use that credit to then hedge the upside so you don't have unlimited risk,
Gotcha.
right? So there is a deep, deep, deep out of the money call that's there to stop the appreciation. Usually it's 50%, 100% out of the money. We never go more than 100 because an ETF can't lose. You're not allowed to lose 100% of your money, right? It's an
Right.
ETF can't go. So if I didn't do that and the market went up more than 100, stock went up more than 100% in a day, the fund would be wiped out and go negative. So, in order to protect against that anomaly, we buy a 50% out of the money call. Now, generally, that will cost less than what that cost to carry earn is, the difference, but it is an additional cost in the inverse. So again, it's look, managing a short portfolio feels like, oh, it should be just like the opposite of a long portfolio. And for the most part it is, but there are nuances in an ETF about managing a short. And even in a brokerage account, right? You get weird things when you're short stock, like it releases buying power and you could short more on the way down, right? You can't do that with long stock. So when you buy long stock, if it goes up, you can't get more shares. You already had your money. In a short portfolio, as the market goes down, you could keep shorting because you're releasing buying power as the amount to cover your short is less and less and less. So for the do-it-yourselfers that have ever traded a short portfolio, you know what I'm talking about. So there's just nuances about a short portfolio. So I know we went deep on that one, apologies, but just think about the inverses as it's the same dynamics, just the other way. So if you want it to be like, hey, look, this coin run is just too much too fast, yes, you buy fiat and you can continue to earn your yield, your expected distribution rate, which is in the 50, 60s right now on coin and fiat. I think fiat might have been a little higher.
Mhm.
And great. So you can continue to earn that distribution and get the yield.
So you're selling put spreads, you're selling the combo, selling call, buying put to be synthetically short the stock, but then you're buying an upside way out of the money call just as an emergency
Yeah.
parachute. Okay.
From time, by the way, that call in fiat right now was fairly profitable to take off
And,
because it appreciated because coin is, up so much, right? Yeah.
now, do you have a dedicated personnel at the scenes, or maybe it's somebody back office who's managing the long and short credits of all the yield max positions, saying, okay, we are we have more long option income ETFs, therefore we are paying the long debit rate at the clearing firm, and we have this small amount that's hasn't taken off yet in dips in Tesla and Fiat, where here's our quote unquote short credit. Or would you say, in general, you've realized after all these years, the longs and shorts of the interest side of the game pretty much evens out over time, and you don't even really look at it?
We have to look at it for sure. And each one of the traders in charge, so there are 25 traders here, right, on these funds, right? So there's a lot of, and part of the methodology we use is you have to be aware of the cost of carry when you're doing a roll, right? When you're taking that synthetic combo and you're moving up to strike or it's going to expire and you have to put on a new one, you absolutely need to be aware of the cost because, and then you shop that, right? And it's strange, you will get different prices. Like this, like the way I just said it is the only cost you're paying for is the cost of carry for adding 3 months. And maybe if you move the strikes around, there's a higher collateral needed. Okay. So that math should be like the least amount of market volatility. That is straight math. There is nothing, doesn't matter if the stock's flying or crashing. None of that matters. It's just that math of how much time and the size of the put assignment, what that notional is. That's the
Mhm.
math. However, you will find that the market makers might have a different interest rate on their book, meaning
100%.
their exposure is like, well, my book is earning 4.25%, and so they're going to charge you 4.25% plus their edge. And then a different market maker might have a 4.5, and so that market maker is going to give you a worse price because they have a higher cost to carry when you're getting long. But I'll sell to that guy because he's got a higher cost to get. So, yeah, so we absolutely watch that. Those trades are, I mean, it's part like nobody wants to give up a 1% for no reason because you're not paying attention to the
Right.
role of synthetic.
Okay. Excellent.
Yeah.
Good answer. Yeah, I think we saw that most um, like during the great financial crisis between like '08 and 2012, that as a trading group, we didn't know whether we should use Fed funds, LIBOR, Eurodollar rate. Like interest rate world was completely messed up, and everybody had different rates, and our heads were spinning.
Well,
Our,
you're all positioned differently because you did a different way of trying to arb interest rates, and all of a sudden stuff
exactly.
changes, and there were different positions on the books. Totally.
Okay, so the next third question here is, in the return of capital is something that comes up all the time, and I'm going to provide a link to the return of capital part of the YieldMax website. But I would say, in general, the people that are posting say, like, they would be okay with receiving lower distributions if they could reduce the NAV erosion. That's the big term that they use in Facebook groups and on, in different channels.
Yeah.
How is the return for like those distributions, like what is the madness behind the science, so to speak, of the distribution rates?
Okay. So yeah, this is a hot topic right now. So everybody has these questions. The first piece, and I think this is one of the other questions that you were thinking about asking me was, how much of this return of capital is actually return of capital
Mhm.
versus technicality that it's a tax qualification? And the answer is almost all of it is a technicality, right? So we have taken a very, very conservative approach on listing the return of capital. And the way that we do it is when we pay a distribution, actually, let me take a step back. The distributions we pay back are based explicitly on the trading revenue we made by selling the call spreads or any realized gains we made from upside capture, right? So
Wait, did you
when
use
we
the word
pay a
exclusively?
distribution,
Right,
right,
okay.
it is just the time value that earned from the calls, right? If sold a call for $3, that time value goes to zero, regardless of what I have to pay to get out of that call.
Mhm.
You're going to get paid $3 in the distribution, right? So what happens is though we are now classifying that if it's not interest from the treasuries, and even in that scenario, like let's say the market dropped and we sold the call for $3 and covered it for zero, and we paid out the $3, because at this point, as we're in like the mid, throughout the year
Mhm.
perspective. That has nothing to do with the middle of the year, but I'm just saying, like, because we haven't done the official end of year, gain loss and attribution reporting, we're going to call all that return to capital. It's not technically it is because it's not income from a treasury
Mhm.
or income from a dividend itself, then we're just calling it return to capital. So it
Gotcha.
looks like we're paying 97%, return to capital on a lot of our funds. But at the end of the year, when we turn around and do that math, if the fund had actually made money, right?
Mhm.
All that'll go to zero. The rock will go to zero. So I think people are getting very distracted by this. Oh, they're just giving your money back. I read an article in the Wall Street Journal today. I mean, this is the journal got it wrong, right?
Mhm.
They're just giving you back most of your money. It is absolutely not true, right? It is definitely not the case. We are paying back in a distribution what was earned from the time decay. If you were just selling covered calls on your own and you left the money in there, right, your account would be appreciating and it would all be part of your total return. We decide to give you the distribution, let you do what you want. You want to reinvest it? Great. It's normally what I recommend. So you compound your shares. If you need to take your 4 to 8% distribution a year out, take that. But taking 50% out in distributions, like, let's think logically about this for a minute there. Like, that obviously is something that you are deliberately divesting to cash when you are taking that out of the fund, right?
Sure.
So the return of capital is a technicality, but we're taking a very conservative approach. Regulators like that approach, but I think we're going to probably start reporting on truly hey, were we up or down for the month? And did you get a distribution? And if you're down for the month in realized gains, that the distribution would be considered return to capital. But I'm going to give you a scenario, Bill.
Mhm.
So I'm gonna put you on the spot, but I know you're going to answer these questions. So here it
Oh
comes.
no.
If I'm long the stock and I'm long the stock at 100 and I sell the 105 call for $1, I have sold how much in time premium in that scenario?
How much time premium you sold? It's 100% time premium.
Well, yes, that's right. $1, and that's
$1.
100% of what I sold, right? We sold
Right.
for $1.
Right.
Now the market goes up, and now the underlying stock is trading at 109, right?
Mhm.
I have to buy back that call I sold the 105, trading at 109. What do I have to buy back that call for?
Gotta buy it back for $4.
$4. Exactly. So I sold for $1, bought it back for $4. What's my net return on that trade?
You lost $3 on
I
that trade,
lost three, right? Okay.
but you made 9 on the stock.
But we made nine on the stock. And
Right.
so the portfolio is up, the NAV is up in that scenario,
Mhm.
and we pay you out the dollar in the distribution. That dollar is still considered return of capital. I ask you this, did I give you back your money when I paid the dollar of no, right?
No.
So this is the thing where there needs to be a different term,
Mhm.
right, to classify this, but this is what the tax term is, and
For
it's
sure.
confusing a lot of folks. In that scenario, we lost money on the call. Absolutely, I lost $3. I
Right.
did, but we made nine, and of that three, I could have lost four, but I only lost three because I had $1 of time premium, where we're then going to turn around and distribute it. So that's the return of capital. So now to your second question about, well, can't you just hold some back and keep the NAV more stable? The stability of the NAV. Okay, let's talk about what the gains and losses are made up of in a YieldMax ETF. There's
Mhm.
two things. There's the income we make from selling options, and then there's the movement of the underlying stock, right?
Yep.
Is there anything else? Forget about treasury rates. Let's pretend like that's irrelevant here, right? Is there anything else that would define the movement of the NAV?
Not really. I think that
No, right.
that covers it.
That's it. So if you have those two pieces and we are going to pay you out the income from the call selling, all that's left is the movement of the underlying, right? So it may feel like, oh, the stock is down, and then you gave me a distribution, you made the NAV go down more. We didn't make the NAV go down. The underlying stock
Right.
movement
For
is the
sure.
thing that made the NAV go down, right? If you look at Palantir or Carvana or Hood, right? Those have NAV appreciation because the underlying is going up,
Right.
right?
I
So
always tell people to look at the not only look at the total return charts because people are like, this is horrible. This is horrible. I'm like, no, dude, you are looking at the wrong symbol. You need to include the total return.tr, and then you see that this is doing fabulously.
Yeah, that this is a little bit of a knowledge and education challenge, which is why we do, I love to do these videos, especially somebody with your expertise here, where we could talk about, your full investment has to include what you got paid in distributions, right?
Right?
You're getting returns, right, from that investment. And by the way, if you had reinvested them all, your chart would be the total return chart, right? It would look the
Right.
same, right? And so I always say, as an advisor, right? I always say, um, like, look, it's the amount of dollars allocated to that position. Who cares what the NAV is? It's, hey, if I started with $10,000 and now tomorrow after we get a dividend and we do the reinvestment, there's $11,000 in there. My position appreciated. The NAV might have dropped. That's okay, but I added more shares and the position size is what matters. You probably do this with rebalancing where you say, okay, I have a target percent that I want allocated to a portfolio. And sometimes that means you're adding to a position or you're taking some off.
Right.
Well, when you have YieldMax in your portfolio, you're going to get a lot of cash on a fairly regular basis, and you should be doing a regular rebalance. That will probably mean some shares going to the YieldMax, but also shares going to other parts of the portfolio that might be underperforming, right? But
100%.
this is all why we have this super high distribution. So I think I saw a comment, on one of my other videos where somebody said, wait, isn't the whole point to be able to take all the yield? Like, why does Jay keep telling me to reinvest the distribution? I never said the whole point was to take all the yield. I actually think these are fairly aggressive investments, like single stock investing, whether it's yield max or not,
Hmm.
is an aggressive position, right? On a scale of 1 to 5, if you're along a lot of Tesla, I'm gonna say you got a 4 to 5 level of risk, right? So
A little bit
so
higher, but
that's
yeah. Yeah,
yeah, it's not, I mean, they are not what I would consider a traditional income strategy. They're an alternative income strategy that has a high risk profile. So,
for
in
sure.
that scenario, my preference, and this is why I tell folks to do that, if you need some yield out of these and you bought these because you like the yield, great. Take what you need, like any advisor would tell you. But the rest you should be reinvesting back into the position and compounding your shares. Because guess what? On the next distribution, you now have more shares. Now, if the NAV is down because of NAV decline, you notice I do not say NAV decay because these are not NAV decay like a commodities product that has contango problems or
Right.
a leverage product that has compounding problems. That's not these, right?
Right.
These are the dynamics of a covered call and ultra high distributions going out. I probably shouldn't coin that phrase, ultra high. This might be the first time I said it. I'm trying to coin that phrase, by the way.
Okay.
Yeah, but if you add more shares, you will have the same dollars of income from the distribution if the rate is the same. And look, maybe if it appreciates, you have even a higher distribution rate that's going to happen, right? So it's
Sure.
one of those things. These are, I would consider these fairly aggressive. Even the Berk's more like, a little less aggressive. It's still equity risk, right? Which is a 3.5 to 4 on my scale when
For
it
sure.
comes to risk out of 5. So, that's it. Like these are not necessarily meant to be like, oh, isn't the whole point to take all the yield? Nope, that's definitely not it. These are alternative income products that happen to be using volatile stocks as the mechanism for generating these distributions and
And
returns.
this is where I veer from the belief system that Dorsey Wright uses because you have some Dorsey Wright ETFs. And I've been a longtime Dorsey Wright subscriber for 25 years, so I love them. Okay. But I use total return when I'm creating my matrices and my watch lists, where Dorsey Wright only uses the underlying security for its technical decision to be in the ETF. And for a reason for that is like I know that the synthetic, like you want a stock in an uptrend, you want positive relative strength, all these kind of things. Okay, 100%. But at the same time, like I don't care, me, if a stock is in the middle of a Dorsey matrix, if the implied volatilities are high, if the distributions are high enough. So for me, I don't look at solely the uptrend or downtrend or comparisons that Dorsey does. I always include the total return portfolio in my decisions for clients. It, but then the reason why I bring that up, Jay, is that there's still so many different ways you can skin a cat. You can you can do the YieldMax ETFs, and you can buy SPY, QQQ, IWM. You can do a YieldMax, you can buy IBIT, YBIT. You can do a YieldMax, you can buy Berkshire, like whatever you want. You can just use it as one additional avenue to build up a position in a portfolio using the YieldMax ETFs, and that's what I do over here for clients.
Yep,
Uh,
that makes sense. And look, that's definitely a perspective. The reason the Dorsey Wright partnership. So these two funds are FIVY and FEAT, Feet for
Mhm.
Feature, and then FIVY is where we kind of do 60% of yield max and 40% of the underlying, right? Which, by the way, does help answer some people's question of like, could you just not distribute as much, right? Like you're going to capture more upside if you
Yeah.
have 60/40 and the market's running. Okay, but nonetheless, the reason we did these is because we had a lot of folks who said, just tell me the best ones to buy, Jay. Like, and I was like, I don't know what are the best ones to buy. It all depends. What's your risk profile? Like, that's not an answer I could
Yeah.
give. So we thought, okay, momentum, which is what Dorsey Wright is really known for, momentum-based investing. Okay, let's partner up with Dorsey Wright, get a signal, let them tell us of all the listed yield maxes that are in the, have a single stock. Just
Mhm.
tell us the ones that have the what you think Dorsey Wright is the most momentum, and we'll put those five in the portfolio.
Love it.
So that was it, right? And you're right. Like, hey, why not analyze the actual data and total return of the yield max? They could, but I believe because their momentum indicators is more about, hey, the underlying has upward
Totally.
momentum,
And
which
I understand
ultimately,
it. And
yeah,
ultimately, the portfolio is going to be successful over time because you're choosing stocks that have a high relative strength, positive momentum.
if they get it right.
If they get it right, yes. So here's a question that just popped in my head. We may go over our 40-minute mark, but
All right.
crazy. Just because, again, being a floor trader, you think outside the box. So U.S. Treasuries as collateral, you are either earning or paying 4.125% in your Treasury position at YieldMax. Can you guys do a carry trade where you're actually can you deliver like Japanese yen bonds at 0 or zero point 0.5 and then scalp the extra 4% in a traditional carry trade that everybody's been talking about since maybe a year ago when it first blew up when Japan
In
raised prices?
August. Yeah. Okay.
Is
So
it too much to ask?
yeah, look, that's not in the prospectus and
Uh-huh.
it's not the focus of these funds. But
Okay.
even if we could, let's talk about what we're really adding to the distribution and the yield, right?
400
Three,
basis
four
points.
percent, right? Yeah. Which is normally you'd be like, wow, that's amazing.
Yeah.
But we're talking about stuff like, whatever the Carvana one, the hood one was, right, this week. It was 125%, right? That's
Yeah.
12,000 basis points. Like, look, it's like,
Yeah.
I think if we really needed to fine tune, we'd have to change the prospectus. Right now, you're talking, and the trading gets a little more complicated, right?
Yeah.
There's
A good point.
entire businesses that just do that carry trade, right? So, you know,
Okay.
there you go.
All right, good. This question is, can you ask Jay if there's anything in the future for a quantum computing ETF or something with nuclear power uh, going forward? I think if you're okay
Quantum and
answering that
nuclear are
question.
different, right? Um, but I could see why they're related, right? The power needed to drive quantum is related. Okay. So for yield max, I'm looking at sorry, I'm looking on my other screen here, the stuff that we filed for already. That's in registration. We have filed for I think the only one that really qualifies is IONQ. So there's a YieldMax IONQ option income strategy that was filed. So that would be a typical, YieldMax single stock on IONQ. I don't think there's any others that I can disclose at this point, but I
Okay.
don't think there's anything else to disclose anyway. There's other semis, right? Like Broadcom is in there and ARM is in there, right? And I wouldn't say they're necessarily known like quantum, but like Rigetti is not in there. By the way, it's one of those things that, when you're looking, those stocks are still a little on the small side,
Right.
right? So you have to be prepared for $100 million to be in any fund, right? Any fund can get to $100 million. Hood went to $100 million this week in 2 days, right?
Oh,
It was 20 million, and then because of the distribution rate and trading, I think it's over 100 million now. I'm just taking a quick look. Yeah, it's 104 million as we're doing this interview, right? So you
okay.
have to be able to make sure that the underlying ticker can handle that
Yeah.
capacity. The options are there, the tradability is there, right? Even the stock volume, because as you know, as a floor trader, every option trade has stocks on the other side. Not the same amount, but there's a delta neutral trade that's on the other side of that. We could probably do a whole thing on delta neutral if anybody really cared. But let's not. But the answer is so it's, none of the other ones that we have filed for have really qualified there. Affirm, AFRM, kind of chip related, but I don't think it's definitely quantum specific. Like IONQ is in the quantum space. So sure, there's one there. Nuclear. I don't see anything that's got a nuclear focus, like a uranium or anything like that.
Right, nuclear. I just had a Zoom call with some advisors that I met through Dorsey Wright, and they're into, I think the symbol was SMR. This is not a recommendation. It's not financial advice, but I think SMR was an energy company, utilities and electricity. New Scale Power Corporation, symbol S is in Sam, M is in Mary, R is in Robert. I mean,
Huh.
that chart is just gone
Oh,
off
yeah.
the rails. And let's see, what is their, see if I can get a volume number here. No, that's not available right here. Interesting. Beta 2.51. Let's see what their implied vols are since I have my think pipes SMR page up. And J, a respectable 88.5 implied volatility on
I
the
mean,
VY
that's
40
not
vol.
bad at all.
That's not bad.
What's I look at the market cap, it's 11 billion. It's
Yeah.
kind of there.
That's like Coinbase.
It's no, Coinbase is bigger than 11 billion.
Is it? Okay.
Yeah. Yeah. Certainly lately.
For sure. For like 2 days
I
ago.
thought I saw 80 or something. Let me take a quick look. Yeah, it's 90 billion on
Oh my,
Coinbase.
okay. Okay.
Yeah.
Me bad. All right. Well, listen, I want to be very respectful of your time, Jay, and I don't really have any substantially different questions than people asked in the first episode or our first interview about return of capital and things like that. So, unless you want to bring something up, you want to talk about something that's, coming down the pipeline that you're permitted to talk about between now and December. I am just thrilled to have you, but I'll give you these few moments to,
So I am going to follow up on one question we had about like, hey, why not just, hold some back? Why distribute all of that? We have filed, and the name on these is probably going to change, but we have filed for yield maxes that have a target of 25. So like, let's say you take, and I can only, because they are not active yet, but MSTT is. So that is MicroStrategy, where we're selling calls and only paying a 25 distribution rate. And so the rationale behind that is capture more upside, have some NAV stability if that's what people want. Your distributions are going to be less because we're going to sell for less income. So there is a difference there. If let's say, for example, with MSTY, we were going to distribute 75% on an annual basis and we hold back 50 of it. So we still made it and it's in there, right? So there's still a lot of the returns driven by cover call income, right? Call selling premium. But we only distribute a quarter. This one's a little different where we are going to be selling a little bit different option lean. If you read the prospectus, it says we are selling monthly calls on MSTR, but farther out of the money with the idea and their spreads with the idea of only making that, whatever it is, 2.1%, 2.2% per month. So then we would only distribute the 25%. And the implication here is that, like, well, we should capture a little more upside if you're going to do something like that. So
Sure.
there is a variation there. We definitely don't want to change what's going on today. We know investors love those ultra high distribution rates when they come out, right? We see volume, we see money flowing in when you post a 60, 70 percent distribution. AMD, it was even a little high this week, right? So we know folks like that. So we'll see, when we go live with these. I don't know what the official name is going to be today. The way we filed it, we call them Target 25s. That name may change a little bit, but that's something to look forward to that is coming. And then the other thing I would say, and I've been, trying to talk about it, we touched on it briefly, is the zero DTEs. Look, if you like the S&P and you want to have like, hey, do you have something that can give me S&P returns with a little alternative income? Look at that SDTY or the QDTY or RDTY. Take a look at those. Performance on those is, generally we have some outperformance against the underlying index, and it's hard to use options to beat the market. So I would say take a look at those, consider those as an add-on or a supplement to your long SPX or long SPY exposure.
Excellent.
That was my pitch. That's the only thing I was really pitching. It
Perfect. Yeah. And listen, thank you.
wasn't even a heavy pitch.
You're good. Jay Pestrichelli from YieldMax, thank you again so much for spending time with us. I really look forward to our next conversation. And I'm going to just hit the pause button, but I just want to ask you a quick question
All right, Bill.
offline. And thank you for being with us, and we'll chat with you soon.
You got it.